Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you're new here and enjoy today's video, be sure to drop me a like and subscribe, and that way you'll be able to see future videos. So for now, let's get into it. So it seems like I have a little bit of a habit of making slightly more controversial videos on this channel. Today I'm going to talk about something that the general investing community tends to be quite afraid of, and that's stock market crashes and stock market volatility in general. So lots of up and down movement in prices. And I'm going to argue the point that stock market volatility and stock market crashes are a good thing and provide a lot of opportunity for investors. So a lot of this thinking comes from Ben Graham's The Intelligent Investor. It's the Bible of value investing. If you want to take a business-minded kind of approach to investing, this is a really good read if you haven't picked it up already. And in the sort of forward of this revised version of The Intelligent Investor, there's a passage there written by Warren Buffett, and Warren Buffett goes into a few really cool points. So he says that long-term success as an investor is not driven by IQ, it's not driven by having insider information or some sort of major edge in the stock market. It's driven by how much time you put towards investing, controlling your emotions, and then how many opportunities you have in terms of inefficiencies in the market. So I want to really dive into that last point today around inefficiencies in the market. So if you don't know, there's two sort of primary theories out there, I guess, around how stocks or shares in businesses are priced in the public markets. So the first one, and the way in which many of the sort of hedge funds and mutual funds out there invest their money, is called efficient market hypothesis. And I'm not going to write that all out, but efficient market hypothesis. If you're a value investor, if you're Warren Buffett, Charlie Munger, Ben Graham, you definitely do not agree with efficient market hypothesis, but I'll run you through what it is anyway. So efficient market hypothesis essentially is a theory that all the information around a company is priced into the stock at all times. So therefore, you can't get a bargain, you can't buy things for less than they're worth, and you can't sell things for far more than they're worth as well. So you can't get a bargain, you can't get more than what it's worth when you actually sell something, and therefore, on average, you can't beat the market. So in terms of explaining what Warren Buffett and Charlie Munger have done over the years, obviously they've destroyed the market over a long period of time. Essentially, the efficient market hypothesis says that they're lucky, says that they're basically monkeys flipping coins, and you can't possibly have that sort of success from intellect or a different strategy or anything like that, because everything is priced at its value at all times, so you can't get a deal. The value investing approach is a lot different to the efficient market hypothesis or the modern portfolio theory, which also ties in with this. Value investors do believe you can get a deal. So they believe that the market sometimes gets irrationally exuberant, so it overprices businesses, which you're able to sell those businesses that you own at a premium. And it underprices those businesses when there's a lot of fear. So you can pick up deals in the market, you can buy things for less than they're worth, and you can therefore generate a very high return by doing that. And there's a story around a professor walking along the courtyard with a student, a professor who believes in who believes in efficient market hypothesis, walking across the courtyard with a student, and the student says, "Look, professor, there's $100 on the ground." And the professor says, "Don't worry about picking it up. If that was a real $100, it wouldn't be there." That's essentially what efficient market hypothesis is saying. But in reality, sometimes those $100 bills are sitting on the ground, and we as investors have got to be able to identify them and pick them up and kind of load up the truck with those $100 bills when those opportunities arise. So just to give you a quick demo of essentially what we're trying to do as value investors, buy things for less than they're worth. The intrinsic value of a company probably looks something like that over time. So it steadily goes up over time as the company grows and becomes more prosperous. And this is all to do with the cash flows of the business. So a value investor works out how much they can afford to pay for a business based off the amount of cash that that company produces each year. And hopefully the amount of that cash that company is producing is going up every year. That's the ideal sort of business. So that's the underlying value of a company. In the stock market, we have massive movements up and down all the time. So the stock price may actually look more like this. So what you might see is that you get these points of overvaluation in the stock market where the price is, for whatever reason, a lot higher than the intrinsic value. And you get these periods where the price is quite depressed, and you are offered a margin of safety. So that's what we call a margin of safety in value investing. You're able to buy something for significantly less than it's worth, and offer yourself protection as an investor should something go wrong. And if you are right, you can generate much higher returns than if you'd bought that company at full price. Because eventually undervalued companies should always correct to their intrinsic value, and then you can begin to think about selling out of that company and earning high returns. So as value investors, what we really struggle with is a market that just goes straight up. So what we've been in the last 10 years or so is a massive bull market, the biggest bull market in history. The stock market's tripled since I think 2008, 2009. What I can tell you up front is that the earning power of companies definitely has not tripled. So people are paying much more per dollar of earnings or per dollar of free cash flow, however you want to measure it, than they were in 2008 and 2009. 2008 and 2009 was an example of one of these periods where we had very depressed prices because there were recessions and things going on, global financial crisis, as I'm sure you all remember. So there was a lot of undervalued companies. It was an example of where you could pretty much throw a dart at a company and pick it up for much less than it was worth. There were obviously bankruptcies and things going on, some companies falling apart, but there were a lot of companies doing really, really well that you could have picked up. And even companies that might have struggled for a couple of years that you could have had a pretty reasonable expectation that they would recover once the kind of global financial world recovered as well. So that's an opportunity to pick up a lot of deals. In terms of the general kind of typical investor that isn't all that familiar with the value investing strategy, they tend to not like market crashes. People don't like seeing 50% drops in their account values. They don't like seeing the retirement funds drop massively. And that puts a lot of fear into people. And that's essentially what helps to drive market prices down even further. When people get scared that, their retirement accounts drop 10% and they think maybe it's going to drop another 10 or 20% again for whatever reason, that forces a lot of selling. It forces a lot of downward pressure on prices. And as value investors, we can pick up a lot of deals. So the more volatility and the big market crashes that we get offer massive opportunities for investors. At the moment, Warren Buffett, for example, is camped out with over $100 billion. He's really struggling to find deals because there's a lot of this going on at the moment. There's a lot of situations where prices are much higher than intrinsic value, and he's struggling to pick up companies. He's so big that he's only got a few companies that he can really invest in, and those big companies are very closely followed by analysts. They're not often underpriced by big margins, and right now a lot of them are quite overpriced. So he's struggling to pick up deals like this, as are many value investors. I'm struggling myself. I'm holding a lot of cash at the moment. I would love to be more invested than I am, but I'm just struggling to find deals. And if you actually go back and read Warren Buffett's original Buffett partnership letters from the early 50s, which I highly recommend, they're really good reads, what he makes very clear in those videos, which he doesn't probably make as clear these days, what he makes clear in those letters rather, not videos, that he doesn't really make probably as clear now, is that Warren Buffett doesn't expect to outperform the market massively when it's going up. He's very, very happy just to take market returns or slightly either side of market returns in bull runs. Where he really excels is in down markets, and you'll see that through some of his returns in the 50s and the 60s. He didn't beat the market massively over the very long term by beating it in bull runs. He kept up with it roughly in bull runs. He was even slightly above or slightly below through bull runs. Where he really did well is in down markets. So since he was buying undervalued stocks, they tend to go down less than the general market, and he was also able to do a lot of buying because as a result of long bull markets, as value investors, you sort of just end up in cash anyway. You start to sell off positions as they become overpriced. There's lots of those opportunities to sell businesses at a premium, but there's far less opportunities to buy businesses at a discount. So that's, in a nutshell, why volatility and big market corrections are really powerful and really good tools for value investors, especially if you have a long-term horizon. Obviously, this is an approach that we're not looking to do when we're a year or two out from retirement. We don't want to see huge fluctuations there because we want a bit of stability, and you obviously want money to live off of at that point. But if you're in the early stages of an investment career or in the middle stages of an investment career looking to continue to grow your net worth, looking for opportunities for discounts to intrinsic value, are definitely going to help you in big market fluctuations, and you being able to hold your nerve as an investor and have a good handle on what a business is actually worth rather than just what the company's priced at all the time and watching those price movements is going to offer you a big edge, and you're going to be able to do really well and be successful in the market. So that's my little rant for today. That's my 2 cents on volatility and market crashes. I think they're fantastic, assuming that you've got cash sitting there ready to go. And that really is the key challenge, I guess, making sure that you do sell into these big bull markets and buy when markets are coming down and individual companies are undervalued. So I hope you enjoyed the video. If you did get something out of it, hit like, hit subscribe, and hit the notification bell so that you can see future uploads as well. But for now, I'll leave you guys to it, and I hope you all have a good day there. Cheers.